Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies. And I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury. So you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
While John Paulson is shunning the crypto craze, many of his peers in the industry are wading deeper into it. Earlier this summer, Steve Cohn's Point72 was hiring a head of cryptocurrencies. The fund told investors it would be remiss to ignore a $2 trillion market. Meanwhile, the family office of billionaire George Soros has started trading Bitcoin. Macro trader Paul Tudor Jones has begun investing in crypto. And Dan Loeb says he was doing a, quote, deep dive. Now, the big financial institutions such as Goldman Sachs and Citigroup are getting in on the game. The result? Hundreds of job openings. Binance, the world's largest crypto exchange, is advertising for 370 jobs. Still, is the talent pool deep enough to fill everyone's needs? A single job posting may attract hundreds of applicants, but finding candidates with the right experience can be difficult. So, some firms are lowering their expectations or changing job criteria.
I always say the best investment for an individual, an average individual, is to buy their own home.
Не нужны мне ни бриллианты, ни ты. Подари мне на прощание цветы. Я поставлю их на зимнее окно. Я решила, что теперь мне. Я решила, что теперь мне. Я решила, что теперь мне все равно. Извинюсь я мне не жаль, что все закончилось внезапно. Мое небо заискрилось синевой. Я на холст лазурной звезды с кисти капну, и волшебный звон, а не твой вой.
A recent survey revealed that we spend about 6.5 hours online every day. Of course, our office work, shopping, banking, entertainment, all these things have made the internet an integral part of our lives. And this relationship is going to get further revolutionized because a few months ago, Airtel became the first telecom brand in India to put 5G to commercial use on a test network. Hello, my name is Nikhil Chawla, the unbiased blogger. I've been analyzing tech and innovation for over a decade. And today, I'm going to analyze 5 ways in which Airtel 5G is going to transform your and my life real soon. One of the biggest successes of Airtel 5G will be the way it revolutionizes healthcare. Being 100 times faster than 4G, Airtel 5G will enable remotely performed examinations and surgeries. It will enable mobile networks to handle telemedicine appointments and will make advanced medical facilities reach the rural areas. This not only means more efficient processes, but also a low mortality rate. Gaming has seen a major transformation in India, especially in the last few years. People have taken to online gaming more than ever before. According to experts, gaming will be the first industry to be impacted by 5G. Airtel 5G will enable one to play high-end games without having any access to high-end gaming consoles. It will also enable and improve quality of cloud gaming. And all my PUBG BGMI enthusiasts, you can say goodbye to high pings. Virtual twin means an exact virtual replica of something in the real world. You can have a virtual replica of anything fitted with sensors that gather the data required to build the virtual twin. With Airtel 5G, you can take virtual tours of showrooms, galleries and malls on your phone. You can see what your car that you're going to buy looks like through a VR tour without really visiting the place. Sounds cool, right? It may be a possibility soon. We have evolved from watching HD video to streaming those in 4K and should soon be doing it effortlessly on 8K. We do live video meetings, we aim to play online games, and the internet is evolving with us. Because with Airtel 5G network, we'll be able to download 4K and 8K content effortlessly. Even with muted speeds during Airtel 5G testing, it was possible to get speeds going up to 1 Gbps. Pandemic gave education a new meaning. With Airtel 5G in place, online classes can be conducted in UHD quality. Not just that, the teachers will also have access to tools like AR/VR to make the teaching more immersive for the students. What more, video notes can be downloaded by children in seconds even on their cellular phones on Airtel 5G. This was just a glimpse of opportunities the 5G era has in store for us. But once the Airtel 5G network is available, there are possibilities that we cannot even comprehend now. So let's fasten our seatbelts and get ready to explore the new era of internet enabled by Airtel 5G.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
We are 100% confident every time we make the investment that it's going to be a big company. We are wrong a lot of the time. For most forms of investing, the mistakes are the investments you make where you lose money, right? In our world, it's the investments you don't make.
He made his first fortune by co-founding companies such as Netscape and Opsware. But Mark Andreessen made his name by launching Andreessen Horowitz, the powerhouse Silicon Valley venture capital firm.
We sort of thought it was time to go back to the well, if you will, and basically build a firm that was actually built by founders who sort of understood the process more deeply.
In 2009, Mark and partner Ben Horowitz started their firm with just $300 million. Fast forward to today, it's a top firm with $18 billion in assets under management.
Certainly at the time of their founding, they had made the claim of, hey, we've built multiple hugely important companies in the past, and we understand not just what it takes to build it, but the actual angst and the plight of the entrepreneur. And that's what attracted a lot of entrepreneurs to ask them to invest.
Pick a big tech name, and chances are Andreessen Horowitz has invested in it. Twitter, Facebook, Airbnb, Coinbase, Affirm, and the list goes on.
There's plenty of very smart people in Silicon Valley, and he's among the very, very few that just are at a different level of intellectual capacity, and he is almost giddily optimistic. He's one of these people that you go to talk to about your problems and come out thinking like, wow, like actually I have it so great.
Mark may be optimistic, but he also knows he can't win every time.
We're trying to do the moonshots. Every once in a while, we're going to have rockets blow up in the launch pad.
Well, let's suppose an entrepreneur says, I've read about Andreessen Horowitz and I've read about Mark Andreessen. I'd like them to back my company. How do they get you to back their company? Do they call you up? They knock on the door? They send you an email? What's the best way for somebody to contact you?
So it's a people business, right? It's a very deep personal people connection business. Like a venture capital investment is the closest thing to a marriage that's not a marriage, right? Because it's a 10 or 15 or 20 year relationship. And so you're really trying hard, and I think this applies in both directions. You're really trying hard to figure out exactly who these people are. Are they the kind of people, are we the kind of people they'll want to be in partnership with for a decade, and vice versa? Typically that starts with a warm introduction. It starts with a way to kind of establish a personal connection, kind of between people where you have people vouching for each other. And then there's a process that follows that.
Well, suppose somebody is a terrific entrepreneur on paper. He or she looks great, but they've really never done this before. They seem to have good education. They seem to have the drive. what's the likelihood that you would back somebody who's never done a deal before?
So if they've never founded a company before, and if they just have a plan, it's very unlikely that they raise sort of called top-end venture capital. However, once in a while, you get somebody who's not done it before, but they've already built the product, right? And so the classic example of this would be Facebook. Mark Zuckerberg had already built Facebook at Harvard, right, by the time he started a company. I was an example of this. I had already built the Mosaic browser by the time I started Netscape. And so a first-time founder who has a product, the Google's another example. The Google guys had built the Google search engine at Stanford. And so if you've already built the product, then you have a calling card to be able to raise money for a venture because you already have something that's real. And so the best thing to do as a first-time founder is actually build a product. Now, there's a chicken and egg thing there, which is you might need the money to build the product, and that's where people get stuck.
Okay, let's suppose somebody comes to you and he or she is well addressed. They come to you from a recommendation by somebody that's good, and they've actually built the product.
Right.
When you look at their deal, do you say, we need to make 10 times our money, 20 times our money, 30 times our money to go forward? How do you assess what kind of profitability you want in order to decide how much you're going to put in and when you're going to do it?
Yeah, so we do some quantitative modeling, especially later stage, but the big question is, could you view a path by which this could be a big, important, independent franchise company for a very long time to come? Like, is this kind of the kernel of something that could grow into being something very important and very large? And if you think that's the case, then kind of the math falls out of that, right? Because almost every time that happens, you end up making a lot of money. So that's really the question. And I would really drill into this concept. We've focused a lot on this concept of importance. Like, does this matter? Like this product in the life of its users or customers, like, is it really going to be fundamental? Is it going to matter? Is everybody in whatever market they're in going to need this product? Are people going to find it inconceivable to live without this product? If we have that, then it's very easy to build the spreadsheet. If we don't have that, and it's just basically like, oh, we think Microsoft will buy this company in 2 years or something, then we would not do that deal.
So let's suppose a proposal comes in and you see the fingerprints of Benchmark on it, right, or the fingerprints of Sequoia or another firm, Accel. Do you say, look, you've been turned down by somebody else, we're not interested, or they have to come to you first for you even to consider it?
So I would say there's not necessarily. So there's a general sense of heat, right? So there's a general sense. The way I would describe it basically is each top-end venture firm has its own bar. So it has its own set of criteria for kind of whether it thinks a deal should be done or not. And then the top-tier venture firms as a group have kind of a collective bar, which is kind of, is a top-tier venture firm going to fund this company or not? And it's actually easier to answer that second question than it is the first question. Like, after you've been in the business for a while, you tend to have a sense of like, okay, this is going to get funded by a top-end venture capital firm or it's not. If it is going to get funded by a top-end venture capital firm, and if my firm doesn't think it's a good idea, you do wonder, like, who's right? Because the other firms are quite smart. And so this is one of the regular discussions that we have, which is like, okay, if another one of these top-end firms is interested in it, that might be a very positive, substantive signal. If the other top-end firms have looked at it and all passed, that might be a substantive negative signal. That said, some of the best deals in history have been passed on by a very large number of people. One of the classic examples, Uber was passed on by a very large number of venture capital firms. Uber was actually available to be invested in on this site called AngelList, where literally anybody with a checkbook can invest. And so every once in a while you get these outliers, and it's fundamentally a game of outliers. Like the money is made on the aberrations. And so I would say you want to be generally open-minded and humble about your conclusions about what all these different signals mean.
So it used to be the case that venture capitalists, let's say the Silicon Valley ones, would look at something called a Series A. What is a Series A investment?
Yeah, so Series A typically means first institutional money. And so it's sort of like the first step towards sort of being a serious business with sort of a serious lead investor, with a serious board of directors, with a serious amount of money, where basically like there's a real commitment being made around to everybody, by everybody around the table, that they're going to really devote like a lot of time and effort to making this thing work.
Okay, so when a typical firm like yours does a Series A round, you expect to do a Series B, and then a Series C, and then typically you go public maybe after Series C. Is that generally the way it used to work?
Well, so the joke is that the goal of every Silicon Valley startup is to get all the way to Series Z, and then every once in a while an accident happens and they go public. That's a joke.
Okay.
Our goal whenever we back these companies is we want these companies to become long-lived, enduring, independent, standalone institutions. That usually results in them going public at some point. Sometimes they go public after 2 rounds of financing or 3 rounds of financing. Sometimes these days they'll actually stay private for longer and they'll raise 5 or 6 or 7 rounds of private financing. One of the things, the returns have gotten bigger, the wins have gotten bigger. A lot of what's happening is the markets have gotten bigger, right? And so you have this gigantic addressable market for these companies. Now you've got 5 billion people on the planet now with smartphones, right, that are networked together. And so you get one of these companies that has mass appeal. They can get really big. It takes a long time to get that big. It takes a lot of money to get that big. But they have a lot of running room. I mean, we have tech companies now that are worth more than $1 trillion, right, which was inconceivable when I started in the industry. It was just like an impossible thing to visualize. And so some of these companies just end up raising a lot more money than the historical norms would suggest, and they stay private for longer, and then later on they go public.
Why do some people not want to go public?
So the public market is a complex and it can be a very hostile environment. Over time, I think it's fair to say the public market has gotten shorter and shorter term in nature. The marginal investor in the public market is very interested in short-term performance. And the number of investors in the public market that really want to invest for a 10 or 20-year period is not that big. And so you can end up with basically this very tightly compressed time frame as a public company where people are really on you about what you're doing for them kind of this quarter or this year. And so some of these more aggressive entrepreneurs that have a 10 or 20-year vision just kind of think they basically want more flexibility in how they build their business. It's possible there's another cyclical boom and bust cycle. Our plan for that cycle would basically be to just keep going.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
The world of venture capital has blown up in 2021. There's never been another year like it. In the first 6 months, startup investment was $292 billion. According to CB Insights, that's just $10 billion short of the capital deployed in all of last year, which holds the current record. The U.S. has accounted for almost half of that investment. And no surprise, at the top of the charts, Silicon Valley was still the dominant startup market. But a number of other locations in the U.S. also set records: Los Angeles, Chicago, Austin, Seattle, Denver, and Dallas. And there were some familiar names among the leading deal makers. Tiger Global Management was by far the most active investor. It completed an average of more than 1 deal per business day. Tiger was followed by Andreessen Horowitz and Sequoia Capital China. All that investing has led to a whole new herd of unicorns, startups valued at a minimum of $1 billion. In the first 6 months of the year, 250 companies had joined the Crunchbase Unicorn Board. That's compared to 161 unicorns for all of 2020. So the venture capital world has been booming. I've never seen anything like this. Is this because people who are venture capitalists are smarter than they used to be? Or because of COVID, everybody is just putting money in the venture things? Why is it so much incredible profits that are being realized by venture capitalists now?
Well, 2 possibilities. One possibility is we've gotten carried away again. So we've gotten ahead of ourselves again, the same way we did in the late 90s. And things are just too hot. And that's a possibility. The other possibility is our society is going through a real technological transformation. And it was already going through a transformation before COVID, and I think there's a good argument that COVID has accelerated that transformation. A lot of digital businesses have really accelerated through COVID. And it feels like the world is going to change in some pretty fundamental ways coming out of COVID. And so in that case, you have these new tech companies basically driving this change and realizing the benefits.
Do you worry that because the economy might soften at some point if interest rates are raised, or just because of the business cycle, the wonderful world of venture capital will slow down a bit? And is that a worry for you?
So it's a cyclical business for sure. It has a history of boom-bust cycles, basically just like any other sector of the economy. That said, I guess I would say we do not have a great track record in our industry of predicting these cycles. And I think most of how we either perform or fail to perform is micro, not macro, which is to say it's based on the success or failure of individual companies. And if you just look at the history of venture capital and startups, many of the best companies have been formed during the hot periods, but also many of the companies have been formed during the cold periods, right? And there are pros and cons to those periods. And so, look, it's possible there's another cyclical boom and bust cycle. Our plan for that cycle would basically be to just keep going, keep working with our existing companies, help them through it, keep investing in new companies all the way through, and basically bet on these sort of micro-level fundamental technological and economic changes that continue to happen.
It seems as if there are no losses anymore. In the old days, the venture capitalists would say maybe they'd make money on 10% of their deals and they'd lose money on 90%, or that's roughly how people might have looked at it. Now you seem to make money on everything. Does anything ever fail anymore?
I can confirm that that is not the case. We made a commitment. This is true. We made a commitment to our investors when we first raised our fund. I said, look, we're trying to get to the moon. We're trying to do the moon shots. Now every once in a while we're going to have rockets blow up in the launch pad and put a big crater in the ground. And so I am pleased to say we do both of those. The statistical kind of layout of top-end venture capital, if you look at like the 50-year history of it, it's actually about a 50-50 success rate. And this is for kind of top decile venture capital, so kind of where you want to be. But it's basically 50% of the companies make money, 50% of the companies lose money. And then, of course, you need the 50% of the companies that make money to make more money than the ones who lose money. And that's the general statistical breakdown.
But it used to be the case if a venture capitalist did a very successful deal, the venture capitalist might make 4, 10, 15 times its money, her money, his money. Now you seem to make 500 times your money in some cases. So, for example, a deal that your firm did, Coinbase, seems to be one of the most successful venture deals of all time. Was that obvious to you when you made the initial investment?
No, these are not. Well, so we are 100% confident every time we make the investment that it's going to be a big company. We are wrong a lot of the time. These companies are very contingent. We like to say there's a lot of path dependence in the system. There's a lot of twists and turns along the way. Look, a huge part of it is the competence and capabilities of the founders, and then ultimately the CEO of the company. And of course, they deserve 99% of the credit when it works out.
Now, historically, venture capitalists used to price deals at, hoping they get a good rate of return. But a firm like SoftBank has come in with enormous amounts of money and paid higher prices than I think even you would pay or other venture capitalists. Has that helped the business, hurt the business, or is it too early to say?
Yeah, so I'm a market fundamentalist. I have great respect for anybody who's fielding money, where they're taking responsibility for the results. And I don't like to prejudge. I think SoftBank has made some actually very good investments. I would say sometimes that amount of money is very helpful to a company, which is it really helps them kind of bootstrap and get big and scale. Sometimes too much money is very damaging for a company, right? And you can really kind of screw up a company. And I think that's also happening.
So what about Silicon Valley versus other parts of the United States? It seems as if all the big deals are coming out of Silicon Valley. Coinbase, I mentioned, Snowflake, Palantir. These are very successful IPOs that were based out of Silicon Valley firms that they put the initial money in. What about Austin, Boston, New York City? Are they able to catch up with you, or Silicon Valley so far ahead that nobody can catch up?
Yeah, so I think this is a real pre-COVID, post-COVID thing that's happening right now. So pre-COVID, Silicon Valley had a very powerful lock, in particular on the talent. I think COVID, in the post-COVID world, that looks like it's changing pretty dramatically because we've all gotten just so much more used to this whole idea of remote work and distributed companies. And so now you see a lot more motion activity happening outside the Valley. And by the way, not just in other cities, right? So it's possible that there's a new Silicon Valley in Austin or Miami or whatever. It's also possible Silicon Valley, we like to say, just moves to the cloud, right? It's also possible these companies kind of shift to running online. And maybe they run without a central location. So our company, Coinbase, as an example, just went public without a headquarters address. Right, they literally declare they took the headquarters address out of their S1 when they went public to make the point that it's now a virtual company, not primarily a physically instantiated company.
So let's talk about the rest of the world for a moment. What about China and India? Are they great potential rivals of Silicon Valley, or they're not really going to be able to compete with what you do?
Yeah, no, and I think they're doing very well. China's been very impressive for the last 20 years or so. They've done very well. Like anybody, they have their own challenges. Like they don't have a perfect system either. So they have their own issues. India has a whole bunch of companies that are doing really well or scaling. I would say both of those countries have very vibrant ecosystems with a lot of very talented people.
Do you invest there?
We don't invest as much there. This is another pre-COVID, post-COVID thing. We historically viewed venture capital as sort of a craft business where you're very hands-on with people who you get to know very well and you partner with for a very long time. And so in the past, we were very worried about trying to do that kind of remotely. But again, like in this new world, we have to revisit that assumption because maybe remote is the default. And I think that's one of the big open questions for how this whole industry is going to work.
Now, one area that your firm has specialized in, though you've done many different areas, but is cryptocurrencies. Many people think that cryptocurrencies are not a real thing and not a great asset category, but you are a big investor in Coinbase, among other things. But I remember coming out here a couple years ago, you told me you were going to look at blockchain and things related to that, and you obviously have done that. What is it about cryptocurrencies that you think makes it an enduring investment proposition?
Yeah, so cryptocurrency is one of these things. It's a little bit like the parable of the blind man and the elephant, which is like people touch it from different sides and people get kind of, I think, distracted and carried away and get kind of energized on these different topics. We view it as fundamentally as a technological transformation. So there's a fundamental technological breakthrough that has actually happened, and it's an area of computer science called distributed consensus. So it's the ability for a lot of basically people and software on the internet to be able to form trust relationships in an untrusted environment. Money is one application of being able to have distributed consensus, but it's only one of those applications. There are many other applications, many other things that people are going to be able to do with this technology. And many of the smartest people in computer science are going into this field, and they're pushing it forward at a really rapid rate. So to us, it looks like it's just the 8th or 9th fundamental architecture change, breakthrough, technological transformation happening in the tech industry. And we take it very seriously because of that.
So your view is not whether Bitcoin is good or not, or worth X or Y, it's just that the whole technology that underlying Bitcoin is going to transform the world?
These are new kinds of computers. So this is the thing that gets very subtle. These are new kinds of, Bitcoin is an internet computer. Bitcoin is an internet computer that's spread out across hundreds of thousands of physical computers all over the world. It's a transaction processing system that runs without any sort of central location. You know, it's like a giant distributed mainframe, and it processes transactions. And out of that transaction processing comes the ability to exchange money. Out of that process comes this token, the Bitcoin token, the coin, that's a representation of value of the underlying system. But it's a complete transaction processing system. Like it's a new kind of financial system.
When people invent something, usually, even if they're shy, they might say, well, I did something nice. How come the inventor of Bitcoin hasn't surfaced publicly?
So this is one of the most amazing things I've ever seen in my life, which is, I would go a step further. Most people, when they invent something this profoundly breakthrough, they actually don't realize how important it is at the time they invent it. And whoever this person or person, thing, AI, government agency, whoever invented this thing, like they knew the importance of what it was from the very beginning, such that they knew it was important to basically hide their identity. And it's incredibly remarkable that they knew that up. It's like Babe Ruth calling a home run. It's just like amazing that they did that. And then it's doubly amazing that they've been able, whoever they are, they've been able to maintain the secret all this time. The way this market tends to work is there are a set of investors that the best entrepreneurs want to take money from, and then there's a lot of other investors that they don't, and that ends up being the kind of big hinge in the market.
Wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
If somebody wants to invest in venture capital, I guess they could call you up and say, I want to put money in your fund, but it's not that easy to get in your funds because funds in Silicon Valley that are well known are often oversubscribed very quickly. How does a professional investor get into one of your funds? Or how does the average person who's sitting watching this show saying, I want to invest with Andreessen Horowitz, if I can, I'll go with some other firm, but I want to be in a good venture firm. How do you know what a good venture firm is, and how do you get into one of those?
Yeah, so generally they're the ones you can't get into, and so the general rule is it's a bad idea to do this. The venture capital firms that are kind of open for outside money are generally the ones you don't want to invest in. So generally speaking, it's a bad idea. There is a platform that is worth looking at for people who want to learn more, and this we are not involved in this, and this is not we're not on this. You can't invest in us through this. This is just an industry observation. There's a platform called AngelList, where basically angel investors are able to basically take money from people who want to follow their deals.
Okay.
It's worth looking at. People should go in very cautiously. This is a very speculative area, but it is a thing to explore.
Let's suppose I'm watching this. I say, I hear what you're saying, but I'm going to try to find some venture firm I'll go. It may not be Andreessen Horowitz or Sequoia, but it'll be okay. I'll try it. I'll learn. What should somebody look for in a venture fund that they're going to invest in? There's a track record, quality of the people, how much money the people in the firm are putting into the deals. What should they look for?
Yeah, so the big thing is the best entrepreneurs get to pick their investors, right? It's the reverse of how most investment markets work, right? So the best entrepreneurs get to select who invests, which venture capital firm invests. And so what you want to pay a lot of attention to is this sort of difference we described between sort of this phenomenon of adverse selection versus positive selection, right? So adverse selection is the deal that I can get into is not the one I want to be in. Right. Positive selection is basically an investor whose brand is magnetic such that the best entrepreneurs will want to be associated with that investor. And the way this market tends to work is there are a set of investors that the best entrepreneurs want to take money from, and then there's a lot of other investors that they don't, and that ends up being the kind of big hinge in the market.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that. Is that right, more or less?
Yeah, exactly right.
And then the fund just typically lasts maybe 10 years or so?
15. Well, these days longer, so often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you would hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different, Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
So let me ask you a few lightning round questions, if I could. Sure. What's the best investment advice you've ever received?
Warren Buffett, probably put all your eggs in one basket and watch that basket. Really know what you're doing. Really deeply understand the nature of what you're investing in, I think.
What's the most common investment mistake that you observe?
I think it's the opposite of that. I think it's people basically, they read about something in the paper, see it on TV, and take a flyer without deeply understanding it.
If I gave you $100,000 tomorrow, what would you do with it?
Put it in an S&P 500 index fund. Don't get fancy. And
what mistake have you made in hindsight that you wish you hadn't made in the investment world?
Oh, so this is a very interesting aspect of venture capital. For most forms of investing, the mistakes are the investments you make where you lose money, right? In our world, it's the investments you don't make. Right, because if I make an investment in venture capital, I can make an investment, I can lose I can lose 1x, right? But if I don't make an investment and it goes up 1,000x, then I have to read about it every day for the next 30 years and think about all the money that I didn't make that I could have made. And so all of the big mistakes in my world are mistakes of commission. They're mistakes of not making the investment.
So the pleasure of being a successful venture capitalist is what? You enjoy building a company from scratch, or at least helping somebody build it. Is that the great pleasure of being a venture capitalist?
Yeah, you get to be part of the team. You know, with basically when these things work, it's amazing, right? It's tremendous when these things really change the world. You know, look, the other part is, you know, the downside is you don't get to run the companies, right? You're a backseat driver, right? You don't get to. You're not the person doing all the work who gets to take all the credit. The advantage is you do get to see all the new things, right? And so you do get a front row seat at this kind of amazing show of all these incredible people with all these new ideas, and that ends up being, I think, a pretty valuable part of it.
at the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think alternatives will continue to be a viable investment. This is the most amazing job that exists. I know you think your job is great. My job is far better.
Kim Loo took a long journey just to get back to where she started.
I was born here in Harlem, so it feels like I've come home.
The recently appointed head of Columbia's $13.5 billion endowment was born roughly a mile from the school's campus, but few people in her neighborhood aspired to the Ivy League.
I didn't just grow up in the Bronx, I grew up in the housing projects in the Bronx, and there was very few people that went to college, let alone go to a college like Penn.
From Penn, Kim headed to Wall Street, then Harvard Business School, and eventually landed at the Ford Foundation.
To say she is a trailblazer is an understatement. Kim Loo has worked in a field that has had very few women and even fewer African-American women.
Kim's career took off when she went to the Carnegie Corporation, where she rose to become the CIO of its $3.5 billion endowment.
I wasn't surprised by Kim's success. Kim was destined to be a leader, to be great, because she works hard.
Now at Columbia, she has her work cut out for her. In recent years, the school's investment office has lagged its Ivy League peers.
We're going to run through that wall, and we're going to set this institution up for the long term.
We're on the campus of Columbia University with Kim Loo, who is the relatively new Chief Executive Officer of the Columbia Investment Management Company. Thank you very much for being with us.
Thank you for having me. It's a pleasure.
Now, why do universities have such big endowments? They all seem to be bigger and bigger than they used to be 20, 30 years ago. Why do universities need these big endowments?
Well, the university's endowments are used both to fund issues that are occurring today and students today, as well as the future, and the number of different types of activities and a number of different types of research they are trying to support. Those issues are growing every day. For instance, Columbia University is trying to tackle the climate issue, no small endeavor. So they have a lot of research behind that, as well as a number of students that they need to support in order to find the solutions to these big, massive problems. And so the endowments grow to support the needs to solve some of these big problems and to educate the students that are going to be the leaders of tomorrow.
Now, typically, a university takes a certain percentage each year out of the endowment to pay for operating costs. It's maybe around 4 to 6%, somewhere in that range, and that's what Columbia does?
Yes.
So you need to make at least each year, I guess, at least 4 to 6% or whatever your ratio is. Is that how you operate, to make sure you have at least that amount?
Yeah, you know, the universities, when we think about ourselves, we think about what the payout is, and the board determines what the payout is. We are not involved in that. But when I think about what is important for me to be successful in my job, is that I want to make sure I get that payout plus whatever inflation exists, because to pay for that same student a year from now will be more expensive than it was to pay for them this year.
Your job is to make certain that the rates of return are as high as realistically they can be. And the rates of return have been very good for all university endowments recently. Is that because the investment managers are so smart, or the markets have been pretty good?
It's a combination. I mean, we hope that we are picking managers that are particularly smart and doing even better than the markets, but the markets have been strong, and it has a lot to do, I think, with both a function of the fact that there's so much technology that makes it more efficient to do a lot of things, and introduces a lot of new ideas and a lot of new opportunities. But on top of that, you know, all of these things are relative investment decisions, right? And so there was a time when people were making absolute decisions, and the option of investing in bonds existed, but now everyone's looking for equity options in order to meet their returns. And so they're making a lot of relative decisions about the best places to put their money. And so that means all the good ideas get bid up. And so there's just a lot of money out there managed by institutions who have high return hurdles that are looking to invest. And so you see some of the best ideas getting more and more expensive.
So do you manage your endowment in-house, or do you use outside managers?
We use outside managers.
So when you're hiring managers, are you looking at their track record, their diversity, their commitment to ESG? What is it that you're looking for?
So I start with looking at their strategy. Is their strategy unique? Does it offer the opportunity for them to make outsized returns? Then I look at their organization. Have they created and built an organization that supports their strategy and makes sense? Then I look at their alignment. Are they aligned with me and Columbia, this institution? And are they treating us as partners? Do they have high integrity? Are they committed to the values that we are committed to? And are they thinking about the long term in the same way that we are thinking about the long term? We then look at the track record to support whether or not the analysis that we've done about all those other things have been shown to be true. Because a lot of times people start with the track record, but track record just tells you what they did with the circumstances that existed in the past. I want to know what they will do going forward. So let's just think about what it takes for them to be successful going forward. And then I look at the track record to see if they have those skills. In that environment, did they do what they were supposed to do?
So let's suppose you decide to invest with manager A or manager B, and they make a great sales pitch to you, and they have a great track record, they're good on ESG and everything else, and they're Columbia graduates too, everything you want. But the performance is not good after 1 year. Do you say goodbye, or do you give them 2 years or 3 years? How long do you give people?
For me, it's always, is the underperformance explainable? Because every strategy has a good time and a bad time, right? So just because they are underperforming the market doesn't mean that they are not a good manager. So if I choose a manager and that manager is a value manager, and value is out of favor and growth is performing, so if I look at them relative to value managers, they're adding a lot of value and they're doing great work. That's different than if just because they're underperforming the market doesn't mean they're not good investors. We choose managers for specific strategies. So we want to look at whether they are performing appropriately for their strategy. Was the reason they're underperforming for an odd reason, idiosyncratic risk that was not predictable? And yes, they underperformed, but they recovered from it really strongly. You give them more time. So it's a matter of understanding what created the underperformance and whether it's something that we think shows an erosion in their ability to outperform. If it doesn't, you stay committed. That's one of the things that we have the benefit of doing because we have diversified portfolios. Each one plays a different role, and so we don't expect them all to perform at the same time.
Now, in universities, sometimes alums and others say, well, universities should disengage and not invest in, let's say, oil or gas or other kinds of things that are socially controversial. How do you deal with those issues as the university chief investment officer?
So when I think about it, I think that it is very important for the investment arm of any institution to be aligned with the values of an institution. On the other hand, as a chief investment officer, as a chief executive officer of the endowment, I want to have as few restrictions as I possibly can because my principal goal is the return. But I don't think that we can do that at the expense of values. And so Columbia has been very clear that they have a value around sustainability. They have a climate school, they have an Earth Institute. I think when the Board of Trustees made a decision to commit to solving this world problem, they decided it was a value of theirs and it was important. And so when I was interviewing for the job, they made it clear to me that that was something that was coming and that it was important, and I didn't argue about it at all because of course I want to make sure that the endowment is managed in a way that it is completely aligned with the university. Having investments in things that probably won't mature for 10 or 20 years is fine because we expect to be here in 10 or 20 years.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
College endowments have changed a lot since 1638. That's when an English minister in America named John Harvard died and left his library of 400 volumes and a sum of £779 to a college established by the Massachusetts Bay Colony. In return, the grateful colonists called the college Harvard. Fast forward to 1985. The colleges known as the Ivy League led higher education when it came to endowments. But some would argue their investing styles really weren't that sophisticated. At Yale, David Swensen inherited a billion-dollar portfolio that was 40% invested in bonds and more than half in U.S. stocks. Over the next 35 years, Swensen transformed the way colleges invested their money by focusing on reallocating assets into non-traditional asset classes. And Yale's endowment grew from $1 billion to $32 billion, even as it was making regular disbursements that allowed Yale to transform its campus. Swensen died in May at the age of 67, but his legacy remains. Universities across the board have reduced dependence on stocks and bonds and moved into alternatives. Across all endowments in 2020, only 12% of holdings were in fixed income and 33% were in global public equities. The rest of the portfolios were focused on alternatives, private equity and venture capital, marketable alternatives, and real assets. It's a mix that the endowment chiefs of the mid-20th century wouldn't have recognized. When university endowments were first starting, and let's say in the early part of the 20th century, they were very modest, but gradually they began to invest in more than fixed income and bonds. And I think Harvard might have been one of the leaders in going to equities in the late 1950s. Now everybody is not just in fixed income and not just in equities, but a large percentage are doing what's called alternatives. Why are alternatives such an important part of the endowment process right now?
Yeah. So increasingly, alternatives are not alternatives, but they're core parts of the portfolio. They were considered alternatives at one point because it was unusual for people to invest in them. And they're particularly a great investment for a foundation or an endowment because they are a long duration asset. You can't get your money back right way. And so it really is an investment for the future, and much about an endowment is an investment for the future. And so it's a great opportunity for us to leverage the fact that we're long in nature. Columbia University expects to be around for hundreds of more years. And so having investments in things that probably won't mature for 10 or 20 years is fine, because we expect to be here in 10 or 20 years.
Let me ask you about the investment world today. Many people are excited about cryptocurrencies. Do you have a view on that?
I think it will have profound effects. It may not. There are many different avenues that it can go. There's stable coins, there's NFTs, there's just the blockchain, the different layers. People are using it for so many different things. I think clearly it's here to stay, and I think clearly it's going to play some role. Not clear what role it will play. And so for us, it's important for us to dabble a little, just so that we make sure that we follow, make sure that we have relationships with people who are going to develop expertise, and we can leverage those expertise to decide which way to go. It is not something that we would invest a lot in at this point. You know, there's a lot of volatility, there's a lot of risk, which is not something that we're necessarily getting paid for right now. But for sure, we have the ability, because we are long-term investors, to explore new roads. Right. And so cryptocurrency is one of them.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
Yeah. I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long and a persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
What about debt? The U.S. government has a lot of debt, by $28 trillion of debt. It's adding about $3.5 trillion a year. Does that worry you?
You know, for a long time, I thought to myself, I was worried about the debt because of the potential impact on inflation and the value of the dollar. But I wasn't super worried about it until you have capacity constraints. We're starting to see capacity constraints which have a much larger impact on inflation. So as far as inflation goes, that's a mounting worry. But you know, the issues around the dollar and the sustainability of the United States and reliability of it, and whether other governments and other places and markets trust the United States, because we do have, you know, the currency is just backed by the promise of the government, so they have to believe in the government. I think we continue to have a place in the world where people feel confident about us, but there are other powers rising every day, and there's other people looking around and trying to make sure that they also have a place, a vocal voice in the world, and we have to be conscious of that, and we have to be careful. And so I think the debt level is something that we have to watch and pay attention to. But if you can print dollars, you can pay your debt.
So let me ask you today, as you look at the investment environment, what makes you the most nervous and what makes you the most optimistic?
I think I'm most optimistic always about technology and how technology is solving so many of the world problems. I do believe that we're going to see solutions to the climate issue. I do believe that there are going to be solutions to lots of medical issues, and you know, the biotech field is awash with wonderful opportunities and brilliant people solving problems. So that makes me incredibly optimistic. I think I'm most pessimistic about the fact that there are so many large world problems that are not things that we as investors can predict the outcomes of. And so since we can't predict the outcomes of these sort of big global geopolitical issues, we're trying to invest around them and trying to hedge as best we can. But it's hard to predict. So, yeah, do I think a lot about what is the relationship between different governments? I think a lot about that. Do I think a lot about the point we talked about the rising debt levels and the impact that will have on the long term and the stability of the economies? Investing implies a level of predictability. It implies a level of trust, and it implies an ability to analyze. So many of these problems are so idiosyncratic and so not predictable, and we don't control the outcomes. And so that worries me. If you want to produce return, you have to be willing to take risk.
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Right now, if you want to buy a stock market index, you can easily do it, or a fixed income index or something. But suppose somebody says, I want to replicate what Columbia does or some other great university in their endowment. There's no way to buy an index that reflects that, is there?
Not currently, although there are people out there who are trying. There are people who are out there trying to find, to pull apart all the different components of value creation in a private market and create baskets or structures that allow you to leverage all those different opportunities. It's challenging. People are working at it. I don't know that I believe that someone has it exactly figured out right now. And also, I don't think you want the median or the average performance in a private structure. You don't get paid for the fact that you've locked up your money when you do that. What you want is to invest with the very best managers. And so that requires active investment versus passive. So I think there are people out there trying. I think it's going to give retail clients the opportunity to invest in some of these opportunities, but it's probably not the way that an institution will approach that market.
So before COVID, there was a thing called cocktail parties where people went to cocktail parties and they talked to each other. When you go to a cocktail party now, and they're coming back, do people say, well, you're in charge of the Columbia's investment endowment, give me some stock tips, or what do you think I should do with my money? Do people ask you for advice all the time, or you just tell them you're only specializing in Columbia and you don't tell them what to do?
I say, the cobbler's children have no shoes. I am an institutional investor. I'm not a retail investor. The risk tolerance of a Columbia University and the duration of a Columbia University is very different than the individual. So I don't give stock advice or market advice.
So let's suppose I said to you, what is the best investment advice you've ever received? What would you say?
I think the best investment advice I've ever received is the fact that we are in the business of taking risk. And so if you want to produce return, you have to be willing to take risk, and you have to be willing to analyze and mitigate that risk the best you can, and to make sure that the return potential of an investment is equal to the risk, but you can't avoid risk.
Okay. Now, what do you think the most common mistake investors make generally?
I think the most common mistakes is following the herd and just doing what everybody else is doing and not making sure that an investment is appropriate for your institution and making sure that the analysis that someone else has done is not appropriate for you or is not congruent with the way you think about the world. I think there are a million ways to make money. I think there are a million strategies that can work. Not every investment is consistent with your strategy. And so I think there's a lot of herd mentality, and that's a huge mistake that happens.
Let's suppose your oldest child came to you and said, I made $100,000 by doing something creative. I invented a company or I did something. I have $100,000. What should I do with $100,000?
I would tell her to go to a professional that deals with retail investors and make sure she invested. I would also, quite honestly, she needs to invest in her future. Young people need to invest in their future. And for different young people, it's different things. My daughter wants to be a lawyer. She should pay for law school, right? That's a great use of that capital. Other people aren't sure what they want to do and they need to park it someplace while they think about it. They should go to a talented individual who is very good at retail investing and have them invest their money for them until they figure out what they need to use it for.
And if somebody was looking to invest in the area, let's suppose the person with $100,000, is there one thing you would say absolutely do not invest in? This is something you should absolutely avoid. Is the worst thing to do with your money right now? Is there one area like that?
I think the answer to that question is, do they need that $100,000 to live? Or is that $100,000, whether they keep it or not, it doesn't matter. If you need that $100,000 to live, you should not be investing in cryptocurrency, right? It is way too volatile. If you don't need it to live, and this is just play money, perhaps you should invest in it. It depends on their risk tolerance. I think that there are absolutely investments that certain people should not be doing. But many of those same investments, somebody who has a really high risk tolerance, they should take a chance.
Now, compared to your time when you went to Wharton, Harvard Business School, and early in your career, do you think women have greater roles in the investment world than they did before? And do you think that's going to get even better than it has been?
I think we are increasingly seeing that the way many people, a lot of diverse types of people think about the world is different than the way traditional investors have thought about it. And I think whether it's true or not, I mean, it's hard to tell. The perception is that women think more long-term than men, and they are more, they think more about investing as opposed to transactions. It's debatable, I don't know, but what I do know is that you invest according to how you came up and your experiences, and they have a diverse set of experiences that are different than some of the more traditional investors have had. And so there's an opportunity for performance.
What's the appeal of the career of being an investment manager for a university? Is it one you recommend for young people? Should they come up and say it's better than private equity to go into this field?
This is the most amazing job that exists. I know you think your job is great. My job is far better. We are obviously a wonderful institution that does great work that a lot of people want to support. I don't think there's very many, if any, managers out there that we wouldn't be able to get at least an audience with when we're trying to do research and due diligence, different opportunities. All of that is usually at our fingertips, where we are able to talk to all sorts of people that growing up I never imagined I'd ever have access to talk to. We can talk to governors, and we can talk to regulators, we can talk to presidents of other countries, and we have a wealth of expertise here in the university. So every day you learn a little more. Every day you get to make an impact on an institution that is doing great work and it's mission-based, and it can feel wonderful that this is what you're going to, what your work supports every day. And I can't think of a better job, right? Every day I'm smarter, and every day I feel good about what I'm doing.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project. Initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
I think it's just been a very interesting time, right? I think so much has happened in these 2 years. Technology, Zooms, George Floyd, I mean, it's a lot. Right? For me as a creative, all of those things have influenced and touched me. And I think it's just great that we can start to see people going, I could do this with you.
In this conversation, you're going to hear about dressing Oscar winners, the return of the catwalk, and whether working from home killed the suit. If you've been dressing for work from just the waist up, you've definitely missed this. The crowds, a touch of glamour, dressing up and heading out. He has dressed heads of state, royalty and Hollywood stars on and off screen. He describes a suit as a coat of armour and believes wearing one boosts confidence. He is a tailor after all. Now he's back for London Fashion Week. Hello and welcome. My guest today is the fashion designer and Savile Row powerhouse, Oswald Boateng. Oswald, great to have you with us.
Thank you. Thank you very
I have
much.
to say, the best dressed man I think I've had in the studio.
Thank you. I'm going to take that. Definitely going to absorb that. Yeah, absolutely. Thank you.
You should. You have not let us down. It's beautiful. What is this? This is...
So this is actually a flannel, very English fabric, but the design is based on a fabric called the kente cloth, which is a fabric that is born out of Ghana, and specifically by the tribe, the Ashanti, who you have specifically young men who weave it, hand weave it.
Men weaving?
Yeah, men, exactly. There's a whole superstition about women weaving. And
okay, there's always a superstition with women.
Exactly. So, and the fabric is always made for effectively chiefs, which are effectively kings. So the way it's like the kente cloth's like a coat of your tribe. Exactly. So so I decided to take that and mix that with English tradition flannel. And usually it's multicolored. So I took all the colors out and made it one solid color. I use fashion and color as a way to modernize the traditional suit. And over time, I never recognized that my culture, my cultural roots were influencing my choices in color. So my color palette was very African without realizing it was African, because the color made sense to me.
Yeah.
I always went for color that had a richness and depth, because if you have a richness and depth in the color, it means, more people can wear it. Everyone would say, I'd hear many times that I can't wear that color because it doesn't work. And I'd say, well, actually, that's really not what it is. Actually, it's like, what shade? There's like 1,000 different versions of blue, and it's endless. So it's all about the right shade. So I developed my own sort of color palette of shades that meant many people could wear. And then it evolved from there. And then at a point when I recognized that my color palette was very based in my African heritage, that's when I started bringing more of my understanding in terms of textile into my work.
London Fashion Week, it's
Yes,
back. There's been a
yes.
break, of course, the pandemic, and
Yes.
this is your first time showing in
12 years, can you imagine?
a
It's
while.
been a while.
So are we seeing things like this in the collection?
You'll see definitely hints of this, definitely. And this is sort of like become my house design fabrics. So you'll definitely see that, and other variations of it.
So the show, I know you can't tell me about the designs, but is there a theme? What's the thought behind it?
So I did this huge show in New York in 2019, and the show was called AI, interesting enough. But instead of saying artificial intelligence, it was more about the individual. So I flipped the letters and I called it authentic identity. So it was more using the language like this. And so the show itself was this bridge between African-American culture and Africa, and finding a way of bridging those positions. And so the collection really was a real clarity on that. So my show that I'm doing here in London is, I'd say, an expansion of that. Now we're kind of in the sort of, like I said, the sort of post-George Floyd time. I thought it'd be great to sort of celebrate Black culture in this country over the last 50 years. It's interesting, there's a company out of Nigeria, fun enough, a fintech business, which is homegrown out of Nigeria. It's a platform that enables farmers. They have like 9 million farmers on their platform, helping them with the agriculture business. And they've actually came in and effectively supported and sponsored this event that I'm creating. And for me, that's quite special, because historically, I would never have thought that an African tech business, homegrown, could be in that position to do that. They're about to list on the New York Stock Exchange.
So the whole thing, behind the scenes through to the designs is funded, and the design has that link.
It has that link, but more importantly, it's a very important point, because in this shifting change of time, it's about having a voice, right? And a voice as a designer, a voice in the tech world. There's this big debate about, do you have enough women? Do you have enough representation, or you brought Black representation? All of this has been a very loud shout for the last, let's say, 12 months, right? And what's beautiful, and I feel quite happy about, is that the traditional rule of it is I would have to go elsewhere to get the support, right? And it's great that it's coming from Africa to actually support something here that's really important, because it's very easy to lose track of, one, the influence and the creative influence of the culture here. Because what makes actually London special, I can say London because I'm a Londoner, is it's a melting pot of lots of cultures. And sort of being able to respect and receive that, I think is London's future. And so I feel that this show will be a very good example, a catalyst for that realization, because it's not about hitting you over the head with this is, you know, who I am. I'm black and I'm proud. It's not about that. It's more about this is who I am, and it's great, and I'm great. I'm happy to be here and contribute. Yeah, so that's really what the show's about.
The U.S. has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
I want to get into some of your designs and how you come to those. But I think what's fascinating with the pandemic is fashion will have changed. I mean, it's always changing, but perhaps this is one of those moments where we don't go back, potentially, especially men, to suits. We were already moving away from them, but now if you've just been on a Zoom call...
Look, I think it's just been a very interesting time, right? I think so much has happened in these 2 years. Technology, Zooms, George Floyd, I mean, it's a lot. For me as a creative, all of those things have influenced and touched me, and I think it's just great that we can start to see people going, I could do this with you, right? And so in terms of what I'm going to do with the collection, there's a strong cultural, African cultural aspect that is probably more visible in my work now than it has been previously, and a real celebration of that. Not that I never did it before, but I feel the time what we're in today allows, and more importantly, I think it's important to demonstrate. I still have the traditional values of my Savaro background because I love that. I love the tailoring of that. And so you see that very distinctly in the collection. But also there's an embrace of this casual wear because no one's had to wear a suit for 2 years.
I think it's quite sad that we'd seen the decline of the suit already, and now perhaps it's maybe gone even more. We've seen in suit sales and all of that, it's down.
It's really down, yeah. I mean, COVID definitely kind of compounded that. And I think prior to that, there was this birth of sort of like casual wear in a way that it was moving into even our work lives in a significant way. But where I position myself, you know, tailoring was never a uniform in my world. You know, tailoring was a choice. So, you know, people would come to me for special occasions, you know, weddings, award ceremonies. And so the dynamic around how I work is more about finding the ingredient for the wearer for whatever the occasion that you need the suit for. So it's slightly different.
It is, but I suppose I'm just asking maybe as well for your view on whether, you know, that moment, I don't know the exact moment, but people stop wearing hats. You know, when I wonder if you think the pandemic is one of those moments, not necessarily just with the suit, but kind of where we get even less formal in some ways in the way that we dress.
I think for sure the pandemic's made us all not maybe pay the same amount of attention because you're at home, right? And you're doing Zoom calls. But in the same breath, now it's starting to shift. We all want to go out, and now we're starting to think about what we're wearing. So that's changed. What's interesting is the purchase online on e-com, because apparently there was a lot of purchases, but very particular type of purchases online. And then
elasticated trousers.
Exactly.
If you're a woman, bigger knickers.
Exactly. So, you know, that's quite interesting. And there's no question that e-com universe, as a consequence of the pandemic, has really shaped the business. And for sure, I've had to react to that.
I think that's interesting as well, because during lockdown, did you have to do consultations remotely? And how did you find moving the business in that way and trying to make those connections? Can you do it?
It was very unusual, actually. And, you know, I tried a few consultations on Zoom, which I did personally, and that was quite interesting. I ended up cracking a lot more jokes. I was more funny on Zoom because the whole thing seemed so crazy to me. Because you're like trying to work out, but could you step further back from the screen?
Yes.
And you know, you're talking to a CEO. You're talking about a CEO who's running like $120 billion. You know, could you just move? Could you turn around? I think there is a way to do it. I need more time to figure it out.
Well, and the advances in technology, the idea that you don't need to measure in person by hand, it can be done by machines. What do you make of all of that?
I think it's the tech's out there. I haven't personally been able to experience it. I mean, ultimately, the best way to do it is if there's some way you're able to use that facial recognition tech on the body. I'm actually of the view that the future would be that everything is made to measure.
Really?
And somehow there is a manufacturing unit that, in a way that you're at home and then you have a request of something and it's made for you at the factory and then sent to you. And I feel that it's possible in the future for that to happen.
Because it's kind of mad that it couldn't, right? That all of it is such an estimate. The idea that one size of a type of size could fit so many people.
Exactly. But it's not just that, because the nature of the business is that I don't know who's going to purchase it. So if I don't know, I have to make 20 variables of size to fit you. See? And so what happens is it's designed to create waste. So if you know the measures, then you don't have to make the 5 sizes to find you.
So that could be the route to a greener future. But, I mean, big fashion, the hugest houses of this, and I'm not talking the couture end, I'm talking the faster end, they still just don't work on anyway that level, do they? The amount of waste is huge. This is a massive issue.
No, it's absolutely. But the thing is, it's also a challenge for them. So unless you're controlling your manufacturing, which a lot of them don't, you know, they may have really good agreements with manufacturers, it's a very difficult one to change outside of creating a system where you can bring the garment that you're no longer working back, where it can be recycled. I don't see how they're going to resolve that issue.
How many suits do you have?
Good question. I recycle. So interesting enough, I only have as much as I need in a given time. So maybe 20, maybe 20.
It?
Yeah, I'll wear it. I'll sell it on.
And I ask that because I'm trying to think about what you said about confidence and what a suit can do.
Yes, absolutely.
So,
absolutely.
Do you really feel in yourself when you put on your suit, what do you feel? How does it change you?
Well, for me, it's interesting because I've been wearing suits since I was 16. So I have a wholly different it's like putting on, it's almost like putting on a tracksuit, I'd imagine, for me, right? So I'm not thinking about it. But if it's something, I think there's two things. One is the suits and having a suit made for you. And then my intention when I create a suit for an individual. So my intention is always to encourage the wearer to be who they are, be in their truth, effectively. And I like to support that in the way I cut the suit. And so once they look at themselves and they're feeling better about who they are, they show more of who they are.
Suits and clothes are our armour a lot of the time. They say how we feel about ourselves a lot. I volunteer with a charity, a women's charity called SmartWorks, where we dress women who are going for job interviews.
Yeah.
And obviously we're not tailoring, it's largely donated clothes. But when you dress a woman, when you dress someone, you help them get dressed as an adult and not as a child.
Absolutely.
The feeling it gives them, the effort's gone into their appearance is extraordinary.
Yes, absolutely. And it's a very good point. You know, when I'm dressing a client and he's putting the suit on for the first time after we've done the fitting process, you know, the dressing of that individual, the experience of putting the jacket, helping them put the trouser on is quite a powerful relationship, actually. Because effectively they undress in front of you.
Yeah.
And then they dress in front of you. And then that experience when they look at themselves in the mirror is quite something, it's quite special.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Are you on social media?
I'm trying. My daughter says I'm hopeless. I'm really trying. You know, I'm still on the fringes of social media.
I think you should stay there.
You know, I'm still. I understand it's. You know, I need to be more engaged, but it's interesting because I think on one hand it's fantastic because then you get a chance to really express, and there's no, in a way, middleman to your communication. But also in the same breath, you know, anyone can say anything they want. Truth or not, they can just say, this is an issue.
There's no gatekeepers in quite the same way. If you start a business now, certainly in the fashion world, you can just get people to wear your stuff, influencers, and then it grows. You don't have to have bricks and mortar on Southern Road anymore.
Exactly, and which is, I have to say, I'm really getting to understand, because the main thing for me is the real kind of, it's always about connecting with the wearer. And I always go back to it. I'm very spiritual about my work. And so, you know, I like that dynamic within every purchase, even if they're not even aware that's what's happening. You know, once they put it on and they start feeling good about themselves, because, you know, I've now been it long enough to be able to say it, you know, because probably historically I wouldn't actually communicate in that way. I'd say, oh, you know, they enjoy wearing my clothes, but it's been a long enough time, I know that's what it does, right? And so that for me is the most important thing, you know, and how do you communicate that on social media is interesting.
And the fashion world sometimes doesn't have the best reputation, divas and the like.
Oh, yes, yes, yes.
And the best behaviours.
Well, I have to say, though, I have to say, in the old days of fashion, you know, you had a lot of that, actually. A lot of egos, huge amount of egos. But I'd say probably in the last 5, 8 years, it's really changed a lot. I remember going to fashion awards and recent, and everyone going up stage, and the speeches were a lot more considered, not so much about what they've achieved or who they are or who they're sitting with. There seems to be a big shift, and it was needed because...
How bad was it before?
At some points, it was a bit just ridiculous, you know. There's a theatre requirement within fashion because you're a creative, you're an artist. So you're entitled to, you know, want to have, you know, purple roses or whatever it is, because this is the vision that inspires you to create. But sometimes the performances went so beyond the realms of reality that
What's your
they need to be grounded. Yeah.
Come back.
They need to be step back.
What's your most diva-ish request, do you think?
That's quite funny, actually.
Go on. What have you always got to have?
Well, no. Actually, me, I think I'm very clear about what I want. I'm very detailed orientated when it comes to my creative.
Okay.
But probably my only major diva moment, I would say, actually was when I was a creative director at Givenchy. I was in the office, design room, and I wasn't getting things done in the time that I wanted, and I couldn't understand. You know, I was very diplomatic, and so I went for lunch with a friend of mine, and I was saying that, you know, guys, I think it's not moving quick enough. And he said, "Yeah, but they're French, you know. You gotta throw a tantrum." I said, "What do you mean? Got to throw a tantrum?" He said, "Yeah, you got to go in there. You got to tell them what you want." So I go and I threw a tantrum, and I got the stuff done immediately.
What does that look like, you throwing a tantrum?
Well, it was quite funny because it was slightly performance. I wanted black tulips. It was a whole thing, black tulips. I want black tulips everywhere for the stage. It was a whole thing.
I want my black tulips and I want them now.
Yeah, basically.
Who's the best person you've dressed? Are you allowed to say? Or a memorable moment for you with all these stories and all these people?
I mean, there's so many. I mean, there's the story of Daniel Day-Lewis dressing him for the BAFTAs when he won for Gangs of New York, I think, yeah. And he came to see me first, and I dressed him up, and that was really beautiful because he went on stage, and when he won the award, he talked about his tailor, but he didn't know how to say it because it was because the thing is when you have that special moment, there's a lot of pressure, right? Yeah. And so well, at least this is what I do. I like to make that moment when I come to dress you a moment where you don't feel that. So it takes a lot of that away. And then when I dressed Jamie Foxx when he won his Oscar for Ray, so that was great.
Incredible movie.
Yeah, great movie. And you know, I've become very good friends with Jamie, and so that was special. I would say there's been many special moments.
And is it special? Of course, they win, and then you see them, and they look sharp. Yeah. They look how you've talked about. But is it the actual connection that's made? That's
for me. What's more important is how they feel. You know, probably I'd say most of the time that I've dressed people, the usual rule is, you know, they go down the carpet and you'd say, look, make sure you tell them I dressed you all.
Yeah.
And I've always been kind of the opposite to that. I've always said, look, if they said, oh, I'll mention, I said, look, don't worry about that. If you're feeling good, it'll be good.
Thank you so much. And thank you so much for being with us. Until we meet again, do stay safe and goodbye. Tyson Fury. His view, he says, for the best place for women is being on their backs or in the kitchen.
It's definitely not something we support.
Front Row, exclusive interviews with the most influential figures in finance. First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
From New York City.
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Geopolitics to the forefront, even as the economy stays hot. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers of Harvard on the proposed gas tax holiday.
I think we are plumbing the depths of new bad ideas.
And Nikki Drexler on the state of the retail industry and where it is headed.
Right now, it's bingo. It's price bingo in America.
It was a week when we woke up every morning and looked to see whether Europe was still intact, with concerns about a possible Russian invasion of Ukraine, despite President Putin's protests to the contrary, even as he said he was running out of patience, and appearing with the German Chancellor Scholz, suggesting bombing might be necessary to stop what he called a genocide.
Allow me to add that in our assessment, what is happening now in the Donbass constitutes genocide.
But while we were all focused on Ukraine, we had more indications of just how hot the U.S. economy really is, with retail sales numbers for January surprisingly high.
Retail sales, a strong advance in January, a big rebound from what we saw in the month of December.
And corporate earnings continue to pour in with mixed results, from Paramount CEO Bob Bakish falling short of expectations because of his streaming investments.
We would have peak streaming losses in terms of investment in 2023, and then they would improve from there, which would return the company to total earnings growth in 24 and beyond.
To blow out earnings from the likes of Walmart and Cisco, both increasing share buybacks. But in the end, the geopolitics and continued concern about the Fed won out over any positive news of the week, as the S&P 500 was down for a second week in a row, this time by 1.6%, putting it off by 9% for the year to date. The Nasdaq fell by 1.76% on the week, while bonds fluctuated, but ended up not far from where they started, with the yield on the 10-year continuing to hover just over 1.9%. And oil actually was down, despite all the anxiety over Ukraine, ending up at about $93 a barrel for Brent. To put this all in perspective, we welcome now Catherine Keating. She's CEO of BNY Mellon Wealth Management, and Joanne Feeney, Advisors Capital Management Portfolio Manager. Thank you both for being here. Welcome back to Wall Street Week. Joanne, let me start with you on this geopolitics. As you talk to your clients, how concerned are they about this? What do you tell them?
Well, you know, David, in the last week, I've actually fielded a number of calls with clients, and some of them ask, you know, why aren't more people talking about this on the investment front? So they're clearly concerned about the, you know, tensions in Ukraine, which seem to be escalating, in addition to the concerns we've been talking about for months, like inflation and interest rates and slowing economic growth. So, you know, they want to know if they need to do anything different in their portfolios. Do we need to change things for them? Or are they well positioned? And the answer to that comes down to really, you know, what's their time frame? We've seen the world confront pandemics, wars, recessions. The stock market suffers for a while, but eventually recovers. So the time horizon for the investor really matters here, as well their risk tolerance for suffering through the volatility. So there are solutions out there, and the solution really depends on the individual investor.
Yeah, I agree with that, Joanne. And in fact, when we think about geopolitical events, believe it or not, they tend to have very short-lived impact on the markets. What really matters is the larger ecosystem in which they're happening. So if we think about 9/11, terrible, terrible tragedy. Markets closed for 4 days. When they reopened the following week, you had a very significant sell-off, but within 2 months, that had actually been recovered. What was more important was the ecosystem that happened in. We were already in a bear market from the tech bubble bursting, and that market continued for a couple of years. I think the other thing that is important when you're thinking about war is, you know, wars take time, right? We've learned that as a country. They take time. They can really impact your fiscal budget for a very long time.
Well, part of the ecosystem, though, Catherine, I wonder, is just volatility. We already had volatility because of the uncertainty about the Fed, triggered by the inflation and other factors. So putting more volatility into that, more uncertainty, what does that do to you as an investor? How do you deal with that kind of volatility going forward, Catherine?
So Joanne said it right. Time horizon matters, and for most investors, their time horizon is actually quite long. They're saving for their retirement or maybe even their children and grandchildren. And so you can withstand volatility if your time horizon is long. The other thing I would say about volatility is, you know, when we come out of a recession and a bear market, as we did over the last 2 years, those early months and years, everything goes in the same direction. It goes up. You don't have the normal volatility, and we haven't. But in fact, when you look at the S&P 500, the average intra-year correction over time is 14%. And yet 70% of the time, the market ends up by the end of the year. Yeah. So this is normal volatility. It just may not feel that way right now.
Joanne, actually, Catherine just talked about a bear market. Is it possible we are entering into a bear market right now?
Well, in some areas of the stock market, we're already in a bear market. Right? Look at infotech, look at other areas of growth, some areas of consumer discretionary communication services. A lot of these stocks have come down, you know, well more than 10%. And their multiples have come down accordingly. And that started before really the Ukraine tensions really heated up. And it was primarily triggered by the Fed signaling that they were going to be raising rates and when rates actually rose. But, you know, back to Catherine's point on the environment in which this higher risk has now arrived. We are the U.S. economy and the global economy still in the midst of a recovery from the worst of the pandemic. So we have a backdrop of production increasing, whether it's in industrials, consumer products, the housing market, right? And these are all trends that are likely to continue despite what is happening in the Ukraine, because, you know, there's more and more production coming online. Cars, for example, have really been held back, and that should ease in the back half of the year, for example, as semiconductor production. New factories come online starting in the middle of this year. So the economic environment is actually fairly positive. We worry, though, right, about the Ukraine situation and how the sanctions that may end up being triggered if this really goes forward will affect particularly the European economy.
Yeah, we would agree with that. And we remind ourselves about the business cycle that we were in when this global pandemic hit. We were actually in an expansionary cycle. It was the longest one on record. Companies were strong, consumers were strong. We got interrupted with this terrible, terrible health crisis. But coming out of it, as Joanne says, the global economy is growing. It may not be growing as fast this year as it was last year, but it's going to still be nice growth. We expect 4% or so in the U.S. this year.
Catherine, I'm curious, going back in history, sanctions. We just heard Joanne refer to sanctions. We had back and forth and up and down all week long, and at the very end of the week, President Biden came out and said that he believes, based on intelligence, that President Putin has actually decided to invade. Let's assume that's right. Let's assume that's right, and sanctions do come. In the past, what has that done to an economy and to businesses? How do you take that into account?
So for the global financial system, the impact of sanctions really depends on the size of the countries and their size in the global economy. And in this case, Russia and Ukraine are actually relatively small in the scale of the global economy. That doesn't mean, however, that sanctions on Russia couldn't have a very severe impact on Russia and its citizens and economy.
And also, right, the impact, even though Europe is voluntarily going to impose these sanctions, it's going to hurt the European economies. And I think that's probably the bigger risk. And, that's why you maybe want to be a little bit careful about some European exposure at this point.
Does it affect the length that you want to go? Do you want it to affect basically how long you want to invest for? Liquidity, do you need to be pretty liquid? Joanne?
Yeah, really depends on the investor. If they need liquidity in the relatively short term, then they probably want to be there already, right? So, if I'm talking to a client who's in our balance strategy and they're 70-30 and they know they're going to have some expenses coming up and they were just planning on selling stocks 6 months from now, they should probably be a little bit more conservative. And that fixed income, even though we're not expecting a lot out of the fixed income world, if you hand select bonds and preferreds, you can protect against some of the risks from rising rates, lock in some income and still be liquid. And so if the time horizon dictates that you're going to need liquidity, you ought to be positioned for that now.
Catherine, do you have clients going to cash or the cash equivalents?
Not really. Not really. When you think about liquidity needs for people, April 15th is a liquidity need, right? So we see people planning for that need every single year. We see it now, but no, we don't see clients going to cash, because if you're a long-term investor, you need to stay invested. The market path is gently sloping upwards over time, despite these volatile periods in between.
Yeah, market timing is always difficult, particularly when there's a war involved, potentially. Thank you so much, Catherine Keating and Joanne Feeney. They're going to be staying with us as we turn to the question of what we should expect from the rest of the year. That's coming up next on Wall Street Week on Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue
innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
This is Wall Street Week. I'm David Weston, and we are back with Joanne Feeney of Advisors Capital Management and Catherine Keating of BNY Mellon Wealth Management. So, Catherine, let me come to you. We had this discussion, good discussion. I was going to ask you about the rest of the year, where the S&P 500 will be. Forget that. What about inflation? Because that's what everybody's talking about. Where do you see inflation now, and where's it going the rest of the year, do you think?
It is the most important question, actually, and it's the first one on everybody's minds. And I think to really understand it, we have to step back and reflect for a moment on what we've been through. As I said, we were in a healthy business cycle that got interrupted by a health recession, not a normal recession, a health recession. People were getting sick from this terrible virus. It made the economy sick. And then we got an unusual kind of medicine, right? We got this $6 trillion in fiscal stimulus in this country, which really changed some things in the recession. The first thing it changed is incomes didn't go down. That's very unusual. Incomes didn't go down. Spending didn't go down. That's very unusual. Normally in a pandemic, we tighten our belts. What happened was people kept spending, but they shifted their spending to goods, right? We weren't buying services. We weren't going on vacation, but we were buying goods, all the things we needed to work at home, the laptops and computers and monitors and all of those things. And all the things we needed to do everything in our lives at home. And I think we're starting to get past some of that. We see some of the it was sort of an economics 101, right? You have all of this demand for goods and you don't have the supply to get them. We see that starting to correct a little bit. The fourth quarter was really a story about restocking inventories. And so I think the question about inflation is, does the torrid pace of consumers buying goods start to come off of its peak? And do we see more normal behavior, which is shifting to services?
Joanne, do you have an answer to that question?
Sure, that's exactly right. I'll put on my economist hat here for a second. But yeah, when you have this demand so high and supply not able to catch up and interest rates not rising for various reasons, the only place the pressure valve can be turned is on the inflation front. And we should, towards the middle of this year, start to lap some of the biggest price increases. So with fiscal spending less than last year, and with a shift back over to services spending, we're already seeing that in the mobility data, more travel, more hotel bookings, more Airbnb bookings coming. That should take a lot of the pressure off inflation, particularly in the beginning of the year, plus more supply, as I mentioned before. More chips from the semiconductor companies mean more cars can be produced and everything else. On the other hand, though, we have to worry a little bit about the labor situation because the pandemic did trigger an awful lot of people to just leave the workforce, particularly the baby boomer generation, and they're not likely to come back. So we have a shortage of labor. We're going to have higher wages. That's going to continue to keep the upward pressure on prices. But with the Fed's actions, with more supply coming on, with the shift over to services spending, it's likely that the torrid pace of inflation does ease a little bit through the course of this year, but it's going to take some time. Probably inflation gets worse as the housing price increases start to filter into the measured inflation numbers. As they've begun to do, it's probably going to get a little bit worse before it actually gets better.
Yeah, we would agree with that. And the thing about goods inflation is that it tends not to be very high, right? There's so much competition, so many brands out there competing for consumer dollars. Sticky inflation is what we really worry about. So we worry about rents and wages in particular. And if you asked us about the one thing we're most focused on, it is that increase in labor costs, because it's running at about 4% a year right now. And what we need is for the Fed to do what it will do, which is raise rates a bit. We need employers to do what they want to do, which is manage their costs and grow their profits. And we need employees to come back to the workforce. And there are things that we're missing, right? We didn't have the normal mobility and immigration over the last couple of years, which is very important. We didn't have mobility of people, be able to move from one place to another to take a job. I think the flexibility that a lot of businesses are adopting are going to will invite people back to the workforce. And we need productivity, which actually we've been living a productivity boom. That's how you recover corporate earnings and recover all the GDP that was lost with fewer workers. We still have 3 million fewer workers.
Joanne, you talk about pressure on prices. What about pressure on portfolio managers? Because in a world where you've got 2 or 3% inflation, a 5% return every year on your portfolio looks pretty good. In a world of 7% inflation, it doesn't look so good. Do you have investors basically saying, wait a second, how can I keep up with this inflation?
Yeah, that's obviously more of a problem for those heavily exposed to fixed income, right? That's where there's going to be a real challenge in keeping up. But, you know, when you think about inflation and stock prices, you recognize that the source of inflation is coming from companies raising prices. They raise prices. That means their revenue goes up. That means their earnings go up. And, commensurately, stock prices tend to follow that. So there's a lot of protection in stock prices for inflation. Plus, you can always direct your portfolio more towards the sort of companies that do better when inflation and interest rates are higher. That could be banks, that could be real estate companies, that could be energy companies. So there are ways to build protection, and we've been doing that for clients for actually quite a while now.
So which stocks do you like right now?
Well, it depends on the sort of client. So for the sort of more conservative client, we're looking for stocks that'll deliver some dividend yield, for example, but it also can appreciate. So in the tech world, a company like Qualcomm or Cisco. For a safer play, a Philip Morris that has a very high dividend yield. And in the energy world, we like Chevron, we like Kinder Morgan. You know, the energy demand is going to continue to be strong because we do think the recovery continues. Plus, by the way, that adds a little bit of insurance against this Ukraine-Russia situation.
So, Catherine, take a look at the rest of the year. As you look out, we can't know for sure. What do you anticipate for the rest of 2022? It's been a rough start to the year, I think it's fair to say.
I think I would say that we anticipate it coming back to a new normal. And what do I mean by that? I mean that we will still have economic growth, but it will be lower than it was, right? Maybe 4% this year in the U.S. We continue to think that stocks can do well, but it will be lower than they were doing the last 3 years, actually, when the S&P 500 almost doubled. We think that we will have inflation, but we think we will transition to a lower inflation rate. And in fact, the end point of inflation really matters, because if you have inflation between 3 and 4%, over time, markets can do very well. That's what it's been for most of our careers. So the end point for inflation really matters.
Joanne, we've seen maybe a little of the bloom come off the rose in growth and go back into value. Do you anticipate that for the rest of the year?
Yeah, no, I think part of the reason why we've had this, what we're calling the great reallocation, right, has been because of the elevated uncertainty, the anticipation of higher rates. We saw folks get out of growth names into safer names, into real estate, banks, et cetera, energy. And the idea there was that, hey, economies are recovering and the rising tide lifts all boats. So why own risky things? Let's own some safe stuff. But as the economic growth does slow down, as is natural when you're coming off a very large recovery, it's going to peter out over time. I think investors are going to recognize that they can no longer get as much appreciation out of those traditional economic-oriented companies. And if they want to build appreciation into their portfolios for the longer term, they're going to have to go back to growth stocks. And if you look at some of the valuations, they've really come down. If you look at the broader infotech sector, for example, the valuations have come down 16 to 18% just since the beginning of the year. And that reflects that reallocation. So we expect a reallocation back towards the growth names as some of these uncertainties recede. And we don't know when that's going to happen, but we do see investors really needing to look for some sources of appreciation for the longer term. And we think that's a lot of the higher quality growth names. And so what we've done is to raise the quality a little bit in some of the growth names that we own. For example, we'll stay with a Palo Alto in the cybersecurity space, which, by the way, is a nice defensive position in case of war, because we do expect cyber attacks to coincide with this potential military event, instead of, say, an Okta, which is in the same space but has some management questions along with it. So we do expect a move towards quality and a move towards growth as we go through the year.
So one last one to you, Catherine, maybe an unfair one. You always like to be diversified. That's the way you hedge. Yep. Is there any reason to be in bonds right now, given rising rates?
So the answer is yes. So year to date, equity markets are down anywhere from 7 to 12%. So if you had a fully equity portfolio, you would be down someplace in that range. Adding bonds to that portfolio probably took your return to, down 7%, right, or so year to date. So you underweight, but you don't eliminate bonds because they do have a role in the portfolio.
And your investors are patient, are they?
They are patient.
Well,
They're
good.
Investing for the long term.
That's the kind of investor you want. Okay, thank you so very much. To Catherine Keating, CEO of BNY Mellon Wealth Management, and Joanne Feeney. She's portfolio manager at Advisors Capital Management. Thank you so much for being with Wall Street Week today. Coming up, we look at the week ahead on markets around the world. That's next on Wall Street Week on Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Wall Street Week. I'm David Weston. It's time now to take a look at what's coming up in the days ahead on Global Wall Street, starting with Juliet Sally in Singapore.
Thanks, David. A busy week of central bank action in the region. The Reserve Bank of New Zealand is likely to hike rates further, while the Bank of Korea is expected to hold fire after January's hike, and Chinese banks will probably quote loan prime rates on par with the levels at January's fixing. Other data includes Thailand's fourth quarter GDP and inflation prints from Singapore and Malaysia. Elsewhere, Hong Kong's financial secretary delivers the annual budget this week, with the financial hub in a perilous position as the government remains steadfast in its dynamic zero COVID strategy. Meanwhile, Australia reopens its borders to vaccinated visa holders for the first time in 2 years. And on that note, Qantas and Singapore Airlines among the companies delivering earnings this week, along with mining giant Rio Tinto. Now over to Anna Edwards in London. Anna?
Thanks, Juliet. The geopolitical situation around Ukraine continues to dominate the agenda for investors. We'll hear from European foreign ministers when they meet in Brussels on Monday after the Munich Security Conference wraps up. Elsewhere, we get more earnings reports from major European corporates, including Barclays and Stellantis, and some important moments for monetary and fiscal policy. We'll hear testimony from the Bank of England Governor Andrew Bailey on Wednesday, and European finance ministers meet in Paris on Friday. Now over to Romain Bostic in New York.
Thanks, Anna. A shortened week ahead for financial markets in the U.S. because of the President's Day holiday on Monday. When folks return Tuesday, they'll be watching for market manufacturing PMIs and the Conference Board's consumer confidence data for a read on economic momentum. Later in the week, we'll get new home sales for January, durable goods orders for the same month, and an update on the Fed's favored measure of inflation, the Personal Consumption Expenditures Price Index, which the Fed officially targets as it aims for that 2% average annual inflation. That index has jumped 5% year over year for 3 consecutive months, and economists expect the latest data for January to show a 6% rise. It will likely add fuel to the debate on whether the Fed should be more aggressive in tightening monetary policy. There are earnings scheduled for the week, including retailers, Macy's, TJX, Home Depot, and Lowe's, as well as e-commerce platforms, eBay and Etsy. Also look for earnings from Dish, Coinbase, Caesars, Moderna, and Monster Beverage. David?
Thanks to Juliet Sally, Anna Edwards, and Romaine Bostic. Coming up, retail sales are back up, but how long will it last? And what's the next new thing in retail? We ask retail guru Mickey Drexler.
I think sale is the enemy of any retailer.
This is Wall Street Week on Bloomberg.
Listen to Bloomberg Radio wherever you are, online at BloombergRadio.com and around the globe via the Bloomberg Business app. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
What do you